battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 years, it's been our mission to deliver both clarity and confidence to help secure your financial future. We are coming to you live from Naperville, quickly approaching our two big events of the spring, our Wealth Insights Forum Tour, starting April 17th at Gibson's Steakhouse in Oak Brook. You've been there before. You've joined us in the past. This is going to be our best one yet. April 17th at Gibson's in Oak Brook. Make it out for that event. It'll be a blast. It's a dinner. And then a week later, we'll see you in Houston at Trulux in the Woodlands, April 24th. Don't miss that event either. Can't wait to see you. Very exciting. Rolling right into the end of the first quarter. Thank you for being back with us. You know, this is the place where we want to give you the clarity, the good news, the data, the math statistics, reasons why you ought to stay on your plan. And I'm telling you, I've been saying it for a couple of weeks now. We are due for a correction. So keep coming back each and every week. Keep coming back to the podcast, read the articles, listen to Bullish. We just did a phenomenal show with Matt Cole, CEO, CIO of Strive Asset Management, all about proxy voting, corporate engagement. Not from a political lens, not from a Republican or Democrat lens, but from a standpoint of not being political, keeping politics out of corporate America altogether, which I think we all can agree on. We do not want companies deciding corporate or government policy. We want companies making excellent products and services, staying out of politics. And if we do have a disagreement politically, we want to decide that at the ballot box, not in the corporate boardroom. So this is very important for democracy, for the future of our country. Listen to that episode 13 of Bullish. It's published everywhere else. We published the Nick Stenger Show. It's on YouTube and Spotify and Apple. I hope you listen. So what we're talking about this week on the show, it's called The Wrong Narrative, is simply the narrative that's been going on for a couple of years now, but even more pervasive now among the bears on Wall Street, I should say, who keep saying that the stock market's only been driven by a few stocks. They say it's the Magnificent Seven. It's the top 10 stocks that are driving the index higher. It's not the other companies. That is simply not true. Now, it is true that some of those Magnificent Seven companies have done extremely well, have done better than the bottom 10 companies, but not every single one of the Mag 7 is actually performing perfectly right now. Google really hasn't done a whole lot here in recent history. We have not had a good return from Apple this year so far. Tesla is still down about 30%. This year, it's down over 50% since all-time high. So it's not like the Mag 7 is the only thing holding up the market. It's not just NVIDIA. It's not just Apple or Microsoft. It's a lot of other value-related companies. It's a lot of other companies that are just simply growing their profits. They're doing better this year than they did last year. It's not just multiple expansion. We're not seeing multiples go from 15 to 20 overnight on a lot of these companies. We're actually seeing multiples stay pretty constant since last year. Valuations are a little higher than they were 5 years ago by just a touch, but they're not, companies are not radically overvalued today because we've seen earnings growth. There's a number of phenomenal companies that pay great dividends that are growing. Again, none of these names that I'm about to mention are buy or sell recommendations. That's not the point. I'm just giving you some examples. JP Morgan, for example, is trading at a 52-week high. We have Dollar General trading up 14, 15% year to date. We have a number of great U.S. companies that have nothing really. I mean, they use technology, but they're not tech stocks. They're not these Mag 7 stocks that are doing great. So my point to you is that companies are doing fine. Companies are making more money now than they were last year, 2 years, 3 years ago. Now, are we going to be at record all-time highs each and every quarter this year? Who knows? Nobody's got a crystal ball. Nobody knows for sure exactly where the stock market's headed, but I would guess that we end this year just a touch higher than we are today, maybe at that 5,200 point zone, maybe even 5,300 points. But along the way, on that journey to, let's say we do get to 52 or 5,300, remember, we're already at 51, 5,200 right now. We could see a big dip before we get back to where we are today. A lot of the stock market's return, I believe, has already been had the first couple months of the year. We've got the classic sell in May and go away. We don't subscribe to that, by the way. There is some truth to it, but we're not market timers. We're not traders. So if you're our client, you're going to see us hand a little bit back of the return we've gotten this year. Don't let that spook you. Don't panic. Don't worry. Just buy more if you can when things are cheap. And I think you're going to be pleasantly surprised by the end of the year that the stock market's up. I don't think that you ought to panic. I think you should use the correction that's coming as a buying opportunity. And if you do that, you'll be fine. So that's what I believe is going to happen. We could see the narrative shift pretty quickly here from not really a matter of economics, although I do think we should be looking at the economic situation. I'm going to share some of the a little bit worrisome news. Remember, we're trying to call balls and strikes. We're going to tell you how we see it. We're not always 100% bullish. Long term, we certainly are, but I will tell you in a second what I think is a risk to the market. We are quickly going to change from a narrative of the Mag 7 and, oh, everything's horrible and awful, it's just the Mag 7, which is not the correct narrative, to it's all about politics. Remember, we are in a hot election year, a very contentious cycle, and we've got half the country that hates one of the guys running and half the country that hates the other guy running. And so anytime we're in an environment like that, people just generally think the world's coming to an end. And you see the gun stores sell more guns than ever. The canned food stores sell more canned food than ever. The bunker people sell more bunkers than ever before. Why? Because people are getting nervous. They're panicking. They're worried about stuff that really they shouldn't be worried about. The world is not going to come to an end if Donald Trump is president. The world's not going to come to an end if Joe Biden is president. That's not how the stock market works. Those guys have very little influence on the day-to-day of the stock market. What has an influence is corporate policy or government policy. And obviously the president can influence that, but more so what we're looking for and what we want to see is gridlock in Washington. The Democrats maybe have one branch of the government. The Republicans have one branch. Maybe the executive branch is either one of these people that you maybe don't like or do like. It doesn't matter. If we have some gridlock in Washington at the end of November, I'm perfectly happy with that. And I think actually that's what the stock market is predicting. I think the stock market is looking at the polling data and it's saying that we're going to have maybe somewhat of a not a red wave necessarily, but maybe some more increased gridlock in the Senate, for example, or maybe even in the executive branch. And if we get to that point and we do have gridlock, the market's going to keep going up. That's just the reality. Again, not without a correction, but it's going to go up over the long run. Why? Because the founders of our country just set it up beautifully where we've got all these checks and balances. So we have our disagreements. We may see somebody might see one issue one way, somebody sees a different issue another way. And what do? Well, we hire politicians to go to Washington and kind of duke it out and battle it out. And when there's gridlock, not a whole lot of anything gets done. Nothing really happens. And you may think, Nick, that's a flaw of Washington, that they just fight and nothing ever gets done. That's actually a benefit. That's one of the best parts of our system, is that there's not usually these wild swings to one side or the other. We've seen policy change over time, and we can argue if that's good or bad. I do think some of the big government policy that's happened the past 10, 15 years has been negative under both types of presidents, by the way, red and blue. But the reality also is that it has moved slowly. And what that does is it creates a more stable environment for businesses to operate. Businesses can figure out bad news. They can deal with bad news. We've got just brilliant people at these top S&P 500 companies, especially as you climb up that food chain to the top 50. These are run by the smartest management teams on earth. And so they're going to figure out what to do with bad news. What they don't like, what companies don't like, what markets don't like is no news. It's uncertainty that drives stocks lower in the short term. So any sense of uncertainty causes some sort of short-term panic. In the end, though, as soon as we get that certainty, stocks are going to be right back to all-time highs. If you try to time that, if you try to get in and get out and go to gold and you're thinking, Nick, I'd really like to build that bunker, fill it with the canned food, the guns, the gold, the, silver coins or whatever it is that you're watching these commercials on TV. I sympathize with you. I understand where you're coming from. We all have that doom and gloom nature built into us. But the reality is, even if you go out and buy all that gold, you can't go cash in your gold bar at Walmart and turn it into food. It doesn't work like that. So a lot of these fears are irrational, and you have to just stay the course. Your best hedge, your best bet to deal with inflation, as I keep reminding you, is companies. It's not gold, it's not silver, it's not real estate, it's not all these different things that the people on TV talk about. It's simply companies. It's an easy answer. That's why they don't talk about it, because it's so basic. You buy McDonald's stock, for example, not telling you go buy it. I'm just giving you an example. You go buy McDonald's stock. If McDonald's has increased the price of the Big Mac by 10%, and you are now paying a little bit more for your Happy Meal or for your combo meal or whatever, it's probably because their input costs have gone up 10%. What does that tell you? Well, while the Big Mac price has gone up dramatically the past 100, 50, 75 years, whatever it's been now, the McDonald's stock price has also gone up a little bit more than that. It's gone up at the rate of inflation plus dividends, plus corporate buybacks, plus capital appreciation. And like I try to remind you on this show, it's all about math. It's all about the numbers. And the way a stock price works over time is it's going to go up at the rate of the dividends added up with corporate buybacks, them buying their share back. So there's not as many shares outstanding of the company. And then the last piece is profit growth. And if you add those three components up, that's where you come up with the stock's return over the long run. So if a stock has gone up 10% a year, most likely what's happened is there's been about 6% capital appreciation. So them raising their profits 6% a year, plus about 2% in dividends if you got a dividend payer. So that's 8%. And then maybe they bought back about 2% of their shares. So that's 10%. It's just 6 plus 2 plus 2. It's just math. Now, in the short run, maybe you have a year where McDonald's goes down 20 or 30% because people are panicking and less patient people than you or I are selling their McDonald's stock, which would just be such a bad idea. I mean, you can have that happen where people panic. And that's when you go out and you say, all right, I'm going to buy some more McDonald's stock, or I'm going to buy more Nvidia, or I'm going to buy whatever it is, the company that I like, that I own, and I'm going to just add more to my position when things get cheap. You do that, that's called rebalancing. You get disciplined with it. You don't worry about where the price is at the time. You just keep buying along the way. And sometimes you buy high, sometimes you buy low. You buy a lot low when the market's down. And then when the market turns around and stocks go back up, you've just made most of your profit, maybe 60, 70% of the profit on that stock during the doom and gloom time where CNBC was telling you to sell and Jim Cramer was yelling about how the world was coming to an end. And we love you, Jim. You're great. But the media is not your friend. And I think that's the key point of what we've tried to remind you. We even have it in the title song of this show, which is battling the doom and gloom and battling the media. The media's job is to sell advertisements. That's their entire business model. How do you sell more advertisements? You sell bad news. Nobody's interested in the story that says, 5 million Americans got to work safely today, or buy stocks, they're going to go up over the long run. Not interesting. Nobody's going to click on those stories, and the viewership will plummet. They've done studies on this. The newsstands that sell positive news, the sales plummet like 80%. So it's all about selling bad news. It's about scaring the crap out of people. Your job is to know that. So when you see the news trying to scare you, or the financial media, it's just media. It's just entertainment. It's not a disciplined long-term investment plan. That's why you got to have an advisor. You may think you're doing fine. You're like, Nick, I'm okay. I know to just ignore it. Well, I've seen what happens to people if they don't have coaching, if they don't have somebody holding their hand through these corrections. What ultimately occurs is they're fine. Maybe they're getting ready to retire and now they're getting more nervous. That next correction or that next panic happens and they hit that sell button. At least with us or another good fiduciary financial advisor that you hire, you can call that first line of defense and get some advice, some hand-holding, some coaching to make sure you don't make that ultimate mistake, which is to panic and sell out of the market when stocks are down. So that is the reality of where we're going this year. Again, we're going to have a correction. It's going to be all about the election. It's going to be all about the political environment. And at the end of the day, none of that's going to be true. None of that's really going to matter in the long run. 5 years from today, I believe stocks will be up. 3 years from today, I believe stocks are going to be up. So stay the course, stay on your plan, and don't let the media scare you out of your ownership of equities. Another point I'll make here is you go, Nick, well, if we get so-and-so in office or we get the same guy in office, it's going to be doom and gloom. Stocks are going to go down. Just remember, some of the best stock market investors are politicians. We've showed you that through Bullish, how a lot of these politicians have made 20, 30, 50% returns. They're not going to let the stock market fall apart. They're invested in it just like you and I are. So stay invested. If you see politicians are still in the market, probably a good sign that we should be in the market too. And that's not a hard and fast rule. It's just an observation of the fact that, all these people that you're worried about are still in the markets. And I actually tend to believe, maybe not with all politicians, but I do believe with a lot of the hedge fund people out there, a lot of the outspoken names. I'm not going to mention any specifically. You know who I'm talking about, though, where they're always doom and gloom. They're always bearish. They're calling for the world to come to an end every time you turn on CNBC. Think about what they're selling. Typically, what they're selling is a hedge fund where they're trying to convince you the market's always just seconds away from a collapse, so they can get you into their 2 and 20 structure where they charge you 2% plus 20% of profits, which is kind of interesting, and that's not a bad model. It's just that's their model. They're selling doom and gloom because they're talking their book. They're trying to sell you their doom and gloom product. Or it's a gold and silver salesman. And so, of course, that person is interested in getting you out of stocks. Why? Because they make money when the market goes down. You got to know what the incentive structure is. If the incentive structure is to keep you on a goals-based long-term plan and not panic, and all the advisors I'm friends with, all the fiduciary advisors that we know and we trust as well, they're all kind of like us. They're going to keep you on a long-term plan. They're not going to panic when things go down. They're going to say, listen, we've got a goals-based plan that's allocated 2 to 3 years of living expenses and put it in something that's safe. We're going to have everything else in the stock market and good companies and do some risk management to make sure that the portfolio is diversified enough. For example, we're not taking risk we don't have to take, for example. And as long as we do that and rebalance, we're fine. So that's the kind of structure you need. That's the kind of structure that's going to keep you from making those big mistakes. So that's the big narrative this year. Be prepared. The narrative shifts quickly. It's coming. You heard it here first. Correction's coming. Nobody knows when, but don't be alarmed when it happens. Now, I'm going to wrap up with one other thing, and that's to say that I believe corporations here are probably dealing with a little bit more inflation than what the media has reported to us, or even what the government numbers have come out as. You go, Nick, how do you know that? Well, the headline number is called CPI. And CPI, it's basically consumer inflation, tells us what you and I are incurring on a regular basis. Those numbers have not looked good. Remember, CPI is mostly, it's a big chunk of its housing, so rents and mortgage payments and all the rest of it. Then some of it's food, some of it's energy, some of it's transportation, so on and so forth. Those numbers have not been good. They have not been going down like the Fed said they would with higher rates. And we kind of predicted that. We said inflation's kind of structurally built into the economy. Don't be surprised if the Fed doesn't cut as fast as you think they are. And we've been saying that. I mean, if you've been on the show, you know that. We've been saying the Fed's not done. We don't think they're cutting. Maybe they're not raising. I think it's unlikely that they raise rates, but I don't think they're cutting as fast as people might think. So that could cause a correction right there. But even a step further than that, the government came out with this sort of made-up number called super core inflation, super CPI. And what they did was they took out what they consider to be prices that they don't think matter. They took out housing, they took out food, they took out energy. Like, well, what are you left with if you don't have those three main things? Healthcare services, transportation. Well, it seems to me Like that's some fancy financial footwork to try and avoid the real problem of what's gone on the past 4 years, which is money printing, devaluing our currency. They're trying to pretend like inflation's not as bad as it seems like. For years now, the Fed has said inflation target is 2%. If you saw what Powell said, I think it was last week or the week before, said, we're not necessarily trying to get back to 2%. In fact, we could settle for 3%. Now, does that mean the world's coming to an end? No. And that's not my point. What I'm saying, though, is I believe we're going to be in a higher inflation environment than people realize for longer. I'll go back to something I said to start out this part. Companies are incurring higher costs than we realize. Companies pass those costs to us as consumers. They don't absorb it, they pass it along. And so you saw PPI, that's the same thing as CPI, consumer inflation. It's the same thing for producers and input costs for manufacturers, for example. Those prices are still rising. They're not coming down as fast as people think. We're also seeing revisions downward with job openings. We're seeing revisions down with GDP. And so I don't think the data is as rosy as people are trying to make it seem. The media is not covering it. They're not talking about it. The media is saying nothing about it. And I believe what's going to happen is companies are going to process a massive round of layoffs. I've said this for a year now. I might have been early last year. I said this in April last year, but I believe massive layoffs are coming. And I'm not talking to the tune of 10% unemployment or anything like that, like we had during COVID. Unemployment during COVID is 10, 12, somewhere in that range. But I do believe we could easily tick up to 5, 6, 7%. It's not overnight. It's not like it all happens at once, but it's more of a rolling round of layoffs, and you're going to see people lose their jobs. It's a terrible thing. It's part of big government. It's part of companies assuming that they can just grow into oblivion forever and get the free money from the federal government, print and spend, and all the rest of it that's gone on here. But in fact, what I believe what's going to happen is you're going to see companies, especially in the big tech space, companies that hired 40 or 50,000 new people the past 5 years or 3 years are going to trim a lot of that off. And we could end up at a point that we were in 2019 where jobs are coming back to a normal place, inflation will slow, and then the Fed's forced to cut interest rates. Along the way, we will have a recession. I don't think it's going to be this year. I don't even necessarily believe it's going to be next year. I think it could be a ways out before we ultimately see that dip. Thank goodness there's so much cash on the sidelines that will bail us out of that. But there is going to be a round of layoffs. And because of that, I would tell you from a personal financial planning standpoint, whether you're working for a Fortune 500 or you own a small business or whatever it might be, just be preparing for a rainy day. It's coming. At some point, there's going to be a slowdown. And one of the big mistakes people made in the 70s was we had all this inflation, all this Arthur Burns did not kill inflation like he should have, and Jimmy Carter's policies were not fantastic, and the policies before him weren't great. People were spending into oblivion, thinking that they were richer than they really were. You've seen your salary maybe go up the past couple of years. You've gone from 50,000 to 75 to 100 or whatever it might be. And then you've also seen your house go up. You've seen it go up maybe 40% in value the past 3 to 5 years. Just be aware of the fact that it's inflationary money. It's not real. Real earnings are actually coming down now. People are quickly going through the cash in their bank accounts. Credit card balances are rising. And so I would just caution you, if you're our client, just make sure you have money for a rainy day. We have done that in the portfolio. If you're with us, we are preparing for a rainy day, not doomsday prepping, but we're just getting the umbrella really ready just in case we get a little bit of a storm. And so that's where you want to be. Don't overdo it here. I do believe there is going to be a little bit of a slowdown in labor. So that's something to be aware of. Again, I don't think it's going to cause this massive all-out panic or problem or anything like that that's going to take us out. but it's just going to be a cause for stay in the stock market. That's your equity hedge. Make sure you got risk management built in. If you do those two things together, you're fine. If you miss one of them, that's where you get yourself into trouble. Maybe you go too conservative, you go too aggressive. Just be in the middle. Be on a goals-based plan. That's my biggest encouragement. I'm going to leave it at that for this week's episode. Again, subscribe to the YouTube channel if you can. Subscribe on Apple. Subscribe on Spotify. We really appreciate it. It helps get the show to more people, quite frankly. And we would so appreciate if you could subscribe, share it with your friends and family. Remember, we're going to have some doom and gloom, so get back on here every week. Go watch Bullish with Matt Cole. That's episode 13 of Bullish. It's on Spotify and Apple and YouTube. Watch that. I hope you enjoy it. We'll see you next episode for another installment of the Nick Stanger Show. Thank you. We'll see you next time.